Welcome to the daily stock Beaver market briefing. Today is August 14, 2026, and we're going to dive straight into the market snapshot. July retail sales fell 0.6%, the first decline in 9 months, and the Dow responded by shedding more than 100 points. Consumer sentiment slid to 51 against expectations of 54.5. Crude oil climbed 1.4% to $82.40 a barrel after the U.S. threatened a naval blockade of Iran. And Bitcoin slipped below $63,000. After 3 straight weekly gains for stocks, today exposed the fault lines beneath the rally. The lead story is the American consumer blinking. Retail sales fell 0.6% in July against an expected rise of 0.1%. The University of Michigan sentiment gauge dropped to 51, and the New York Fed now counts 4.7% of consumer debt as delinquent. Stocks wobbled, but the real action was in currencies. The soft data priced out Fed rate hikes and hammered the dollar, with sterling climbing above 1.35 to a 3-month high. Second, a textbook sell the news in chips. Applied Materials posted record quarterly results Thursday. Revenue up 25% to $9.12 billion, yet slid 5.7% in pre-market trading. Third, energy is carrying a geopolitical premium. That blockade threat, plus a drone strike on a Russian oil terminal, has crude up 5.4% for the week. Coming up this hour, silver's 2.5% weekly climb, and the Fed picture, where the 30-year yield is holding at 5.24% ahead of next week's minutes. Step back and the pattern is rotation, not retreat. Megacap tech cooled while small caps, energy and utilities led. But with the VIX near the lows and hedging thin, this market is confident to the point of exposed. The long bond remains the warning worth watching. Now the dashboard. The S&P 500 closed at 7786, down 0.17%. The nasdaq fell 0.28% to about 26,730. The Dow dropped 0.20% to about 53,730. And the Russell 2000 bucked the tape, up 0.51% to 3068. The VIX Fear Index sits at 14.25, calm territory, meaning nobody is paying much for protection. The regime remains bullish. Bonds. The long-term Treasury fund TLT fell 0.67% to 82.4, and the 10-year yield slipped 2 basis points to 4.68%. The national debt now stands near $39.9 trillion, up about $21 billion today. We dig deep into the federal budget later in the show. Gold rose 0.26% to $4,432. Silver is at $65.11, and we'll go much deeper on precious metals coming up next. Oil sits at $82.40. And Bitcoin, at about $62.8 thousand, down 0.93%, keeps flashing fading risk appetite. 7 sectors finished green, 7 finished red. But this wasn't a sell-off, it was a rotation. Energy led the tape at plus 1.38%, and that's the Iran story landing in your portfolio. Every dollar of geopolitical premium in crude flows straight to drillers and refiners. Materials added 0.69% on the same commodity current, and utilities climbed 0.58%. No accident in a week when GE Vernova reported orders up 88% to $24.2 billion. The AI build-out is, at its core, an electricity build-out. The laggards tell the mirror story. Software fell 2.7%, by far the day's biggest outlier, as investors took profits in high multiple growth names, a fitting coda to a week where analysts observed that AI stocks have become more volatile than Bitcoin. Tech slipped 0.35%, healthcare 0.48%. And note that semiconductors finished essentially flat, down just 0.6%. That scary Applied Materials pre-market drop had largely healed by the closing bell. Improving breadth away from the megacaps is the bull case's last, best defense, and it's showing up in the small caps. And the commodity trade doesn't end with oil, because silver is quietly having a strong week, which is exactly where we head next. Weekend review. For the trading week of August 7th through today, the question was whether an oil shock and a soft consumer could crack a 3-week winning streak. The answer, barely a dent, and the split between the indexes tells you why. The S&P 500 gained 0.37%, its third consecutive weekly advance, as the Wall Street Journal noted, while the Dow slipped 0.56%, the giants treading water while the tape broadened beneath them. The real information sits in the small caps. The Russell 2000 rose 1.12%, roughly 3 times the S&P's pace, and it leads every major index this year at 22.33%. When the smallest companies outpace the giants by that margin, this isn't risk-off, It's rotation with a risk-on tilt, and it fits a year in which market breadth keeps widening. The sector board shows exactly where the money went. Energy didn't just lead, it lapped the field, up 7.58% on the week and 35.77% on the year, while consumer discretionary fell 1.16%, the week's worst, even with fresh numbers from Tapestry. That divergence is the whole year in miniature, and the macro data explains it. Retail sales fell 0.6% in July, the first decline in 9 months, and Michigan sentiment printed 51 against 54.5 expected. Capital is stepping away from the American shopper. Set discretionary's 1.71% year-to-date gain against semiconductors at 75.47%, and the structure of 2026 is unmistakable. Money chasing scarcity and compute, not consumption. And with 12 of 14 sectors rising, even utilities added 1.52% after PPL's earnings. This is money moving, not leaving. Across asset classes, the unusual part is what rose together. Stocks, gold, and crude all gained in the same week. Oil jumped 5.4% to about $82.40. Gold added 0.74%, and equities shrugged it off. A market that absorbs an inflationary supply shock rather than fleeing it is telling you something. The shock reads as scarcity, not demand destruction. The dollar index was essentially flat, down 0.6%, but Friday's direction matters more than the size, because once weak retail data priced out a September Fed hike, the buck slipped. The two dissenters marked the stress points. The 30-year Treasury fell 0.49% on the week and sits down 5.4% this year. The long end keeps flashing fiscal alarm beneath the equity highs. And Bitcoin dropped 3.11%, now down 29.19% for the year, the weakest major asset of 2026. It isn't crashing on fear, it's being outcompeted. Miners are literally unplugging from Bitcoin to power AI computing, the network's hash rate down roughly 17% from its peak, even as strategist Jerome Blockland notes AI chip stocks have become more volatile than crypto itself. So call it a rotation week, not a retreat. Leadership broadening from semiconductors to small caps, energy and utilities even as the consumer wobbles. The bull market continues while quietly changing its fuel. Next week brings the Fed minutes, and the question is whether July's stumble was a one-month blip, partly an Amazon Prime Day pulled forward into June, some analysts argue, or the start of something colder. Either way, the week's biggest action was in commodities, and that's where we go now, energy first, then the precious metals everyone keeps asking about. Commodities. The dominant commodity story of 2026 is scarcity, and the refined products are the tell. Heating oil futures are up 96.4% year-to-date. Wholesale gasoline is up 70.5%. When fuels nearly double in a year, demand isn't the driver, supply is. And the sleeper on this board is wheat, quietly up 46.5%, a war and weather story with a straight line to your grocery bill. One caution as we go, these are wholesale futures. What you pay at the pump, and the store follows with a lag and a smaller move, but the direction travels. Energy is repricing a blockade. Crude sits at $82.41, up 5.4% on the week, and the catalyst stacked up fast. Washington threatened to keep its naval blockade of Iranian ports going indefinitely. The Strait of Hormuz remains effectively closed. At least 4 Asian refiners bought U.S. crude this week, and a drone attack halted loadings at Russia's Black Sea Sheskharis terminal. That's why refined products lead. Heating oil gained 6.5% this week, because a blockade strangles the refinery, not just the wellhead. Even gasoline's 7.4% Friday drop reads as profit-taking, not a turn. It's still up more than 70% this year. Natural gas is the contrarian corner at $2.71, still down 25.1% year-to-date. The one energy market the blockade can't fix. Though recovering, LNG demand and Europe's winter storage shortfall lifted it 1.8% this week. Government data says the squeeze is real, and more importantly, where it's coming from. The EIA reported crude stocks drew 6.1 million barrels while refinery demand for crude ran flat at about 17.2 million barrels a day. That pairing is the insight. The draw wasn't refiners working harder, it was barrels leaving the country, which squares with Asian buyers turning to American oil while Hormuz stays shut. Gasoline inventories drew another 968,000 barrels, leaving product cover tight into Labor Day. The refinery gate is where this shock reaches consumers. Gas storage, by contrast, built above normal for mid-August, which is exactly why natural gas is the year's laggard. Abundance at home, scarcity abroad. Now the smart money, and the two sides of this market disagree in the most informative way. Hedge funds are only modestly long crude, 7.4% of the market, The long side at just the 15th percentile of the past 6 years. But the producers, the companies that actually pump the oil, are hedging at the 3rd percentile, the lowest in our 6-year records. When drillers refuse to lock in these prices, that's the industry itself voting for higher crude. The crowded corner is gasoline. Fund longs at the 91st percentile, a trade that unwinds violently if a ceasefire breaks out. In natural gas, big traders are 21% short, also the 91st percentile but covering fast. Put together, funds are long the shortage, not the economy. Metals are running 2 stories at once, and the split is the signal. Gold, around $4,400, is up 9.3% over the past month, yet only 2.3% this year, and it stalled this week near $4,500 resistance. That's the fiscal alarm plus war trade. A softening dollar, a 30-year Treasury yield above 5%, and a Fed now expected to stand pat. Silver is the quiet outperformer, up more than 2% this week and nearly 13% over the month, yet still down 8.7% year-to-date. Strong momentum on a depressed level makes silver a catch-up trade, not a crowded one. Copper, up 16.2% this year, confirms the AI build-out is really an electricity build-out. Precious and industrial metals rising together says the market fears inflation, not recession. Positioning adds nuance and one warning. In gold, big traders are 26.8% long, the 86th percentile, while the short side has essentially evaporated at the 3rd percentile. There's no short covering fuel left. Gold now needs willing buyers, not forced ones, a market that rises slower and falls faster. Miners like the oil producers refuse to hedge, 8.3% short, the 16th percentile again. The people who know the metal best aren't selling it forward. Silver's fund longs sit at just the 8th percentile, the uncrowded way to own the same theme. Copper is the honest 3-way fight. Funds 30% long at the 75th percentile, while producers sell into that strength at the 68th. And the reversal risk is specific. If the war escalates and revives dollar demand, crowded gold longs are the flush trade. Now your grocery bill, where wheat is the story. It's up 46.5% this year, with another 5.6% gain this week, and wheat is the commodity behind flour, bread, and pasta. At these levels, baked goods prices stay under pressure well into fall. Coffee is the rare relief, down 7% this week and 12.7% on the year, which is what a supply chain healing looks like. And sugar has climbed almost 12% in the past month, the sweetener quietly tracking the energy complex. Futures move first. Grocery prices follow with a lag and a smaller magnitude, but the direction travels. Agriculture is the least crowded corner of the board, 0 risk flags in our data, which is exactly why the few real moves stand out. Funds are net short wheat by about 31,000 contracts, while producers hedge at the 56th percentile. Both sides agreeing on the downside, even after a 46% price run. A rare consensus that says this rally rides fundamentals, not speculators. The drama was sugar. Nearly 137,000 contracts of short covering in a single week, enough to flip our sentiment indicator bullish. That's the momentum trade on this board. And cocoa, with fund longs at the 2nd percentile, is simply abandoned. The contrarian's free option, because with nobody left holding it, any supply hiccup forces a scramble. Now let's see how the dollar is holding up. Currencies. The dollar has run a split personality year, stronger against the euro and the yen, weaker against the Aussie and the pound. And the index is up just 1.34% for all of 2026, which is to say, no trend, only cross-currents. This week the story turned to dollar weakness, and the reason is the American shopper. After retail sales fell 0.6% and Michigan's sentiment printed 51, markets priced out a September Fed hike, and the buck slipped across the board, the euro trading near 1.15, the pound at a 3-month high above 1.35. The yen went the other way entirely. The dollar reclaimed 159.33, up 1% on the week, handing back gains that US and Japanese intervention had won. A dollar that falls on data but rises on the yen is a rate story wearing a currency costume. And the Aussie is the year's champion among majors, up 5.8%, a commodity currency riding the energy rally, the forex expression of everything we just saw on the commodities board. In emerging markets, the outliers sort by economics, not geography. Asia's importers are paying for the shock. Turkey's lira has lost 11.3% this year, India's rupee 6.1%. Latin America's exporters are banking it, Mexico's peso is 5.3% stronger. Same oil shock, opposite effects. The terms of trade are doing the sorting, and as long as the blockade holds, this map is a live ledger of who pays and who profits. And here's the twist in our smart money data. The single most crowded position in our entire book is a bet against the euro, hedge funds short at the 98th percentile of 6 years. effectively wagering the dollar comes roaring back. Meanwhile, pension funds and institutions sit more than half long the euro on the other side. When the fastest money and the slowest money stand on opposite sides of the same trade, something gives, and it usually gives violently. Funds are also heavily short the Canadian dollar at the 89th percentile, a trade losing ground as the loonie strengthens. The fast money is fighting the tape, positioned for war escalation reviving the dollar, not for a deepening consumer slowdown. What does this mean for you? A mixed picture. Europe is slightly cheaper than in January. The euro is down 1.6% against the dollar this year, but Australia costs about 6% more and Britain a touch more. The bottom line, the dollar's fate now hinges on a tug-of-war between a weakening consumer that drags it down and any Gulf escalation that would revive it, with the Fed and next week's minutes caught in between. Treasury and Rates. Staying with the rates story, the yield curve is steepening, and the message is about the government's credit, not the economy's health. The 30-year yields 5.24% against 4.20% on the 2-year, the curve back in positive territory, but for the wrong reason. Long yields rising, not short ones falling. This week the long end did the moving. The 30-year yield rose 7 basis points while the 1-year fell 3, a bear steepening that says investors demand more to lend to Washington for decades, with the oil shock fanning inflation fears on top. For real people, the split matters enormously. Savers still earn real income at the front end, 3.78% on 1-month bills, so money markets keep paying. Borrowers face the opposite. That 5.24% long yield keeps 30-year mortgages elevated. And anyone holding long-term bond funds feels it. The big long-term Treasury ETF trades near $82, roughly a halving from its peak on the world's supposedly safest debt. When the risk-free asset halves, the word risk-free is doing a lot of work. Where is the action? FINRA's tape shows about $1.2 trillion of treasuries traded on August 13th, and 47% of it was dealer to customer, meaning real money was nearly half the tape. That's not machine churn. That's pensions and insurers actively repositioning duration, concentrated at the long end, where the fiscal debate lives. When real money trades that size, the fiscal story isn't theoretical, it's on the tape. Our positioning data shows hedge funds short the entire curve, 43.5% short the 2-year, the 10-year short at the 82nd percentile, while pension funds hold the other side, roughly half the market long at every maturity. Notice the contradiction. Funds added to that 2-year short the very weak consumer weakness won the argument, a bet on rate hikes that Friday's retail sales made less likely. That's the definition of a crowded position fighting the data. And the 10-year short has already begun covering about 54,000 contracts in a week, the first crack showing. In equities, the same tension. Leveraged funds remain net short roughly 256,000 S&P 500 contracts even after covering about 61,000, while institutions, the pension funds and endowments, are 36.4% long underneath them. Fast money hedged, slow money invested. Historically, a setup where the market grinds higher and forces the shorts to chase. And the VIX carries our only high-risk flag in the entire book. Funds long volatility at the 97th percentile, more crowded crash insurance than at almost any point in 6 years. Crowded insurance is expensive insurance, and in calm markets it bleeds. The bleeding has begun. Step back and every market we've covered tells one story. A fault line between a weakening consumer and an Iranian supply shock, with crowds leaning hard into both sides. Funds on the scarcity trades, gasoline at the 91st percentile, gold the 86th, copper the 75th, while the producers who know these industries best refuse to hedge almost everywhere. That alignment argues the risk is timing, not direction. The danger sits in the crowded shorts. The euro at the 98th percentile, the 2-year treasury at 43.5% short, Bitcoin at 56.4% short, all of which lose violently if the consumer keeps deteriorating. Our stock Beaver positioning analysis as of August 11th flags 3 spots. The VIX is high risk. If you've been paying up for crash protection, know the crowd already has. That insurance is expensive. The 2-year treasury short is the most asymmetric pain trade on the board, one more weak consumer print forces covering at scale. And Bitcoin with funds 56% short is squeeze prone. The big money is positioned for scarcity and fiscal stress, but the real danger is building in crowded bets caught against a softening consumer. Now let's pull back for the bigger picture. The Fed, the jobs market, and where the economy goes from here. Economy and the Fed. That bigger picture starts where every cycle does, with the indicators that move first. The recession clock, our composite of the indicators that turn first, reads expansion, with an imminent score of just 27.2 out of 100. In plain English, no recession signal is active. The yield curve has steepened back to normal, the 10-year sitting 0.76% above the 3-month bill, and that matters because the snapback from inversion is historically the most imminent tell. A calm, positive curve is genuine reassurance. The SOM rule, the early warning jobs trigger, reads 0.10. It takes 0.50 to trip, so we're nowhere near the wire. The one soft spot, building permits down 1.8%. Housing leads this cycle, so that's the crack to watch even while the clock says steady. And keep the sequencing straight. GDP and payroll headlines only confirm, months late. The clock is the forecast. This week's scoreboard backs one thesis. The backdrop eased, a growth repricing, not an inflation scare. The 5-year real yield fell to 2.11%, the market marking down the real return this economy can deliver. The 10-year Treasury slipped to 4.63%. Jobless claims rose 4.5% to 209,000, demand cooling at the margin. But the number that didn't move is the tell. The 10-year break-even market inflation expectations flat at 2.24%. Rates fell while expectations held still, which means nobody is panicking about prices. Cooling demand, anchored inflation, soft evidence for the clock's expansion verdict. The jobs picture is mixed, and the mix is the message. July payrolls fell 23,000 against 80,000 expected. Government cuts did the dragging, yet unemployment fell to 4.1%. Soft headline, firm household survey. The duration data is where cycles whisper. The count of people unemployed less than 5 weeks dropped 22% last month. Layoffs are actually slowing. Meanwhile, the group out of work 5 to 14 weeks jumped 36.5% in a single month. The recently jobless aren't landing on their feet anymore. That's the classic cooling sequence. Losing a job gets rarer while finding the next one takes longer. The labor market is slowing through the hiring channel, not the firing one. Here's the week's most instructive chart with a short lesson. Every Treasury yield is 2 lines stacked. The inflation investors expect, the break-even, plus the real return they demand above it. This week, the split did all the talking. The 5-year break-even, flat at 2.21%. The real yield line, down to 2.11%. The entire decline came from the real side, a growth call, not an inflation call. The Fed logic follows. With expectations anchored, it can look through an oil shock simply by holding, and a falling real yield eases financial conditions without the Fed lifting a finger. That also relieves gold, whose headwind is a rising real rate. And credit agrees there's no default scare priced. Junk spreads near 2.71%, remarkably tight. The 10-year at 4.63% reaches your wallet 2 ways. For savers, cash still pays. The effective Fed funds rate sits at 3.63%. Money market funds in the mid-3s. For borrowers, the weekly mortgage survey puts the 30-year home loan at 6.67%, no relief coming. And that's the number that decides whether housing thaws. Cash earning 3.5, while a house costs 6.75 to finance. That gap keeps housing frozen and bond income attractive. Inflation is above target but behaving, and the split tells you where the risk sits. The Fed's preferred gauge, core PCE, ran 3.29% as of June, still well above target, no victory laps. And the pipeline matters more. Producer prices for services are up 4.7%, and producers lead consumers by roughly a month. Tomorrow's CPI pressure, visible today. Yet the market doesn't believe the pipeline, break-evens sit essentially on target. And the sleeper, CPI energy, actually fell 1.5% in July. The crude spike hasn't reached consumer prices yet. August's CPI is where it either bites or gets looked through. A quiet regime change at the Fed. Total assets stand at $6.76 trillion, up $11.4 billion this week, tiny, but the direction is the story. After 2 years of shrinkage, the balance sheet is growing again. Composition is why your mortgage hasn't budged. Mortgage holdings slipped to $1.93 trillion, down $17.5 billion on the month. The Fed still letting the housing market's biggest buyer walk away. One reason home loans sit near 6.7%. And the system shock absorber is gone. Reverse repos held roughly $90 billion a year ago. Today, a rounding error. The next squeeze has no cushion to land on. Watch reserves for funding stress. Fear is asleep, selectively. The S&P's VIX closed the week at 14.63, calm to the point of complacency, the kind of reading that historically precedes volatility. Underneath, the divergence. The NASDAQ 100's gauge runs 21.23, 6.5 points above the broad market. When tech volatility runs hot while index volatility sleeps, the market is telling you exactly where it thinks the risk lives. And the St. Louis Fed Stress Index reads minus 0.77, about as calm as that gauge gets. Serene on the surface, anxious underneath. The same pattern our positioning data flagged, and margin debt will back it up shortly. Now the consumer, stripped of inflation. Real retail sales are up just 1.7% from a year ago, volume barely growing, and volume is what the economy actually ships. On this chart, steady growth is a straight line, so July's bend is the tell. The 0.6% nominal drop you heard at the top of the show. Prices up near 3%, real volumes up under 2%, a shopper standing still. Same cart, bigger bill. A consumer standing still is the Fed's strongest argument against tightening further, and the soft spot beneath that expansion read clock. Wages are cooling from both sides. Average hourly earnings rose just 0.1% in July, a third of the expected pace. The miss matters, wage momentum is fading. For the year, earnings are up 3.2%, set against CPI at 3.3%. The average raise runs just below inflation, paychecks holding ground, not gaining it. That's the retail charts shopper, not cautious by choice, constrained by arithmetic. No wage price spiral here, which keeps the door open to easier policy if the shopper keeps fading. Now the clock stress test, cyclical jobs. Factory and construction payrolls, the ones that cut first in a downturn, total about 20.95 million, still rising. When a cycle turns, these jobs go first. They're not going. The factory activity index printed 55.6, comfortably above the 50 growth line and better than expected. And hold that against the jobs chart. The leading signals, those lengthening jobless spells, say hiring is slowing while the cyclical engine still turns over. Slowing, not contracting, the leading edge is bending, not breaking. One late cycle flag before we leave the macro. Investor leverage. The same complacency the VIX was wearing. FINRA margin debt hit about $1.42 trillion in July, up 38.6% year over year, and buildups that fast have historically appeared near major market tops. July brought a dent of caution, down 5.65% on the month, but the net credit balance sits at negative $995 billion. Investors borrowed well past their cash cushion. With financial conditions loose, this is fuel. It makes rallies fast and corrections faster. Last chart, the oil to rates channel, where the textbook got rewritten this week. The old rule, oil up, inflation expectations up, yields up. But check the decomposition we just walked, break-evens flat at 2.21%, so the live channel isn't expectations at all. This week even the real rate channel went quiet. Crude rallied about 5% while the 5-year yield fell. The bond market is treating war premium oil as a supply shock to look through, not an inflation impulse to price, doing the Fed's looking through for it. Watch for the flip. The day break-evens climb together with crude is the day the Fed's patience faces its real test. So does the week reinforce the clock? Softly, yes. Expansion 27.2 out of 100, hiring slowing at the margin, cyclical jobs still rising, expectations anchored, and real yields doing the easing the Fed declined to do. Watch the claims trend, watch permits, and watch August CPI for the oil premium. Cooling, not cracking. From the economy's thermostat, we turn now to the corporate scorecard. Earnings pulse. 3 sectors made the cut in this week's earnings flow, and the mood on the calls is strikingly consistent. Utilities takes the first slot as the top-performing sector of the week, up 1.52%. 4 of 6 companies beat on earnings, 1 raised guidance, 5 maintained, and the tone is bullish. Technology carried the heaviest reporting calendar, a clean 6 of 6 beat on earnings, all 6 beat on revenue, and every single one raised guidance. Real estate rounds it out, only 3 of 6 beat on the bottom line but 5 of 6 raised guidance. Let's break them down. Utilities is the week's top mover even though the sector is up just 2.41% year to date. And the thesis from these calls is that pricing power is consolidating, not fragmenting, into scarcity owners monetizing existing generation, tariff architects converting regulated volume into contractual floors, and mechanism-rich compounders riding riders and trackers. Constellation Energy, ticker CEG, is the scarcity owner in full. It beat earnings at $2.55 a share, raised full-year guidance by 50 cents to $11.50 to $12.50, and told investors it signed roughly 920 megawatts of long-term nuclear contracts this quarter at an average duration of 18.5 years, including Walmart's first nuclear power agreement. About 30% of its clean baseload output is now locked in long-term, and the stock is up 6.6% since the call. Vistra, ticker VST, shows the other edge of the same blade. It missed on earnings and revenue and struck a mixed tone. 2026 is tracking at or above the midpoint, but management conceded 2027 leans toward the low end because Texas power prices are meaningfully lower. Still, the chief executive made the scarcity case bluntly. $30 per megawatt hour, in his words, is not going to get new stuff built. Equipment costs have doubled or tripled, and new build contracts run near 90. Adjusted EBITDA of $1.767 billion was up more than 30% year over year. PPL Corporation missed the quarter by a penny at $0.33 a share. Yet investors looked past it because its Pennsylvania data center pipeline hit 32 gigawatts, the 10th straight quarter of growth. NiSource, ticker NI, is the sector's laggard, down 4.6% since its call, with quarterly earnings of $0.16, down from $0.22 on storm costs and labor negotiations, though a 9-gigawatt data center pipeline anchors its long-term story. Notably, not one utility cut guidance this week. Technology delivered the cleanest sweep you'll see, 8 calls in the past week, and all 6 names in our table beat on earnings, beat on revenue, and raised guidance. The verdict: pricing power in tech is consolidating into choke points. CoreWeave, ticker CRWV, is the choke point in its purest form. The AI cloud operator grew revenue 112% to $2.6 billion, expanded its backlog to $104.2 billion, up 246%, and said near-term capacity is effectively sold out. In July, it raised prices roughly 25% across its computing tiers, and in management's words, demand, pricing, and margin are all expanding. Shares are up 19.4% since the call. One caution for income-focused listeners: CoreWeave still lost $626 million in the quarter under $640 million of interest expense. Impressive operator, heavily levered. Lumentum, ticker LIGHT, tells the same story in optics. Revenue up 109% to $1.1 billion, gross margin crossing 50%, a level originally targeted at a $2 billion quarterly run rate, and management has even repriced part of its backlog. Shares up 13.8%. Then the twist: Applied Materials, ticker AMAT, printed $9.1 billion of revenue, up 25%, earned $3.50 a share, up 41%, and raised its calendar 2026 outlook for the third time this year. Customers are booking chip tools on rolling forecasts stretching to 2030. The stock is down 7.5% since the call. Cisco, ticker CSCO, saw orders jump 35%, raised guidance, and still fell 7.3%. When a perfect report card gets sold, expectations are the story, and Cisco's pricing detail explains the pressure. Price increases added about 5 points of growth, and in Cisco's words, customers do not like it. But understand, memory inflation is an industry issue, not a Cisco issue. Real estate made the cut on news flow. Guidance revisions skewed overwhelmingly positive, with 5 of the 6 names here raising their outlooks. The thesis: pricing power is consolidating into platforms that own scarce, irreplicable capacity and operate it at industry-leading cost. Iron Mountain, ticker IRM, is the winner, up 3.1%. The storage company turned data center landlord grew revenue 19% to $2.3 billion, and its data center leasing already totals 110 megawatts this year, past its own full-year target of 100, with renewal pricing up 12% on a cash basis. The caution flag is Alexandria Real Estate, ticker ARE, the sector's only miss and hold. It posted a loss of $0.43 a share against expectations near 9 cents, kept guidance unchanged, and the stock is down 9.2% since the call. Same property NOI fell 10.6%, occupancy sits at 86.9%, and management is candidly meeting the market, offering concessions to fill lab space. The life science recovery is real, but for now it's arriving on the tenants' terms. Between those polls, Simon Property Group missed the earnings print, yet raised its full-year funds from operations guidance to $13.20 to $13.30, because the landlord leverage is unmistakable. New leases are signing at about $78 per square foot against in-place rents of $60 to $65. Initial rents up 17% while tenant concessions fall 12%, and management sees no signs of a slowdown. Host Hotels and Resorts is pushing the same playbook in travel. Transient revenue up 7% on essentially flat room nights. Rate over volume and guests keep paying. Stitch the 3 together and one theme dominates. Pricing power is consolidating into whoever already owns the scarce thing: contracted nuclear plants, sold-out computing capacity, irreplicable retail and data center space. All 3 sectors read bullish on tone, yet reactions diverged. Utilities rewarded, technology sold a perfect report card, real estate split between raisers and concession givers. High expectations, real leverage at the choke points. Now let's see how this lands on our top stock and ETF picks. Market technicals. Since January, energy stocks have run the table, up 35.62%, and here's the catch: the leader is also the most stretched. sitting 9.5% above its 50-day moving average. That's the average price of the past 50 days, its trend line. When the winner leans that far past its own trend, it's the most likely spot to pause. Not panic, pause. At the other end, the long Treasury fund TLT is the year's laggard, down 5.73%. And the breadth underneath is genuinely healthy. 90% of what we track trades above its trend line, so this isn't a rally carried by a handful of giants. Momentum, measured by RSI, a 0 to 100 speedometer where 70 is hot and 30 is washed out, averages about 50, dead neutral. Small caps are the sleeper, up 22.62% and a whisker from their high for the year. Over the past 3 months, money has been chasing the jumpy stuff. Healthcare and financials are beating the S&P by 10.38 and 9.63 points over 12 weeks, with both small-cap benchmarks right behind. The laggards are the hiding places, utilities and long treasuries trailing badly. Beta, simply how much a fund jumps when the market moves, tells the story. Small caps run a beta of 1.25 while utilities sit at 0.16, and it's the jumpy end doing the leading. That is a market comfortable taking risk, not seeking shelter. One caution light. Financials, 9.4% above their trend line and still climbing, running hard, due for a breath. On sector strength, financials top the board with the hottest reading, energy and healthcare close behind. Healthcare's RSI sits at 62, warm but a good distance from the 70 overheat line. Utilities anchor the bottom. The tell is in the middle. Real estate is stretched on its own trend yet lagging the market, a combination that usually means late and vulnerable. The easy money there has likely been made. Communications is the mirror image. Beaten down all year, down 3.38%, yet its shortest-term trend has just turned up. That's early money, quietly shopping the aisle nobody else is. Step from sectors to styles, and 2026 belongs to deep value. Funds of cheap, unloved companies carry the strongest scores on the board, with small-size funds right behind, a leadership that has now held for 5 straight weeks. The washed-out corner is growth funds and the long bond. The two styles that own the last decade are this year's laggards, and a rotation may be budding. Momentum, left for dead, has crept back to the middle of the board. When a dead style starts crossing the middle, that's often the first sign leadership is broadening rather than ending. Zoom out, and the whole market's technical health scores 80.3 out of 100, solidly in extended territory. Translation: the trend is up and intact, but you'd be buying strength, not bargains. The gauge agrees with the price line. It simply warns there's little cushion beneath it if the news turns. Extended isn't broken. It's a market that has climbed a long way without much of a rest. Money flow agrees. Our own approximation, built from weekly dollar volume and original stock Beaver Red, not anyone's proprietary gauge, also lands at 80.3 in accumulation territory. Plain English, more money is still flowing in than out, and it confirms what prices are doing. When price and flow point the same direction, you can trust the trend a bit more. It's when they diverge that trouble usually starts. And the crowd. Our stock Beaver sentiment composite reads 73 greed territory. What's driving it is calm. The VIX Fear Index sits at 14.63, scoring 93 on its pillar, about as sleepy as fear pricing gets, with strong market momentum behind it. The break is the market's own speedometer, an RSI of 48 dead neutral, meaning stocks aren't being chased at any price. And versus a year ago, sentiment has actually cooled. The long-run series reads about 58 today against roughly 82 last summer. Greedy, yes, but cooler greed than a year ago. If you watch one thing this week, watch energy and financials, the two hottest tickets on the board. If they catch their breath while money tiptoes back into utilities and long bonds, this whole rotation is telling you it's ready for a rest. Top stock picks. From corporate earnings to the stocks themselves, the heart of the show, top stock picks. As we always do, we start with the buy signal radar, our mechanical screen for stocks trading in active bull trends. Tonight that radar is crowded. 99 stocks are flashing buy signals. That breadth matters. Even with the major indexes drifting a touch lower today, the S&P 500 off about 0.2%, the volatility index sits at just 14.25. Underneath the wobble, this is still a trend-friendly tape. The longest streaks on the board run 4 straight days. Palantir PLTR at $179.1, Newmont NEM at $114.19, Uber UBER at $75.88, Airbnb ABNB at $185.13, and Viva VEEV at $252.64. But what we prize most is confluence, a mechanical buy signal that lines up with strength in our performance rankings. Tonight that shows up in Marathon Petroleum, MPC, Hewlett-Packard Enterprise, HPE, and Super Microcomputer, SMCI, all on 3-day buy streaks and all among our hottest momentum names. Nebius Group carries the same confluence on a 2-day signal. Hold those names in mind because they're about to come up again. So what's hot this week? Nebius Group, NBIS, at $277.68, up 47.7% in 7 days, and the fuel is fundamentals. Coverage of its second quarter shows revenue up 454% year-over-year to $582.3 million, the AI cloud business driving 98% of sales, and annual recurring revenue reaching $3 billion. Just as important for a capital-hungry builder, customer prepayments now cover half to 60% of contract costs, which takes a real bite out of the funding risk. The company is also extending its AI infrastructure footprint in Britain with a deployment in Newport, Wales. Fair warning from the skeptics, though the heavy debt behind this build-out makes it a bumpy ride. Supermicrocomputer, SMCI, at $39.84 is up 28% this week, and by multiple accounts more than 60% since the month began. The catalyst is demand. Reports point to record order backlogs and compute supply that can't keep up, and Citigroup lifted its price target from $33 to $39 on Thursday. Yes, margins are squeezed by big hyperscale customers, but demand running ahead of supply is a good problem to have. Seagate Technology, STX, at $973.44, up 19.8% this week, is the AI trade's quiet compounder. Every AI data center needs mass capacity storage, and analysts keep marking earnings estimates higher. Marathon Petroleum, MPC, at $355.42, up 19.2% this week, earns its heat honestly. Zacks credits strong second quarter results and higher refining margins, with the stock up more than 50% since those numbers landed. And note the confluence, Marathon is hot this week, and up 115.2% year to date. One more before we pivot. Workday, WDAY, at $198.68, surged nearly 18% in a single session, reportedly its best day in a decade, after Reuters reported talks with private equity firm Silver Lake over a deal valuing the software maker near $43 billion. It's up 40.1% over the past month, yet still slightly underwater for the year. That's a recovery story, not a runaway. The recovery theme carries into our swing list. CoreWeave, CRWV, at $105.26, reported strong second quarter results on August 11, and the number everyone's talking about is the backlog. A record $104.2 billion in contracted business, more than $129 billion counting incremental commitments, built on 112% revenue growth and a 59% adjusted EBITDA margin. The company just closed a $2.6 billion loan facility to fund the build-out and added Masterclass as a customer for its AI teaching agents. On our earnings pulse, CoreWeave beat and raised, capacity sold out, prices lifted 25%. Shares are up 16.1% this week and 36.5% on the month. Albemarle ALB, at $136.15, is the classic bottom of the cycle swing. The lithium producer still carries a 22.5% loss over 3 months after weak lithium prices, but lithium has recovered to $20 per kilogram, and the company is now a focused pure play with $2.7 billion in liquidity after selling its catalysts business. It sits on a 3-day buy signal, early innings, choppy action, but the turn is there. Now step back to the year-to-date leaderboard, because the same names keep appearing, and that overlap is the most compelling signal in tonight's data. Seagate leads at 238.5%, Nebius follows at 208.7%, Micron at 208.1%, Hewlett-Packard Enterprise at 142.9%, Marathon at 115.2%. 3 of the 5, Seagate, Nebius, and Marathon, also sit on this week's hottest list. A stock that's hot this week and up triple digits for the year isn't a pop, that's persistence. Which brings us to the big picture, our best performers over 6 months. Nebius at 184.7% and Hewlett-Packard Enterprise at 167.2% set the pace, with Micron at 143% and Seagate at 134% right behind. 2 deserve a closer look. Micron Mu, at $971.66, drew an upgrade to buy today from New Street Research, whose analysts argue AI demand could turn the memory maker into a $2 trillion to $3 trillion business by the end of the decade. The stock is already up 42.6% in 3 months. And Hewlett-Packard Enterprise, HPE, at $58.71, cleared a real hurdle when a judge affirmed the settlement allowing its Juniper Networks acquisition. That overhang is gone, and shares are up 77.9% over 3 months on AI server demand. The sleeper group is energy. Valero VLO at $341.67 hit a 52-week high this week, and veteran investor Steve Weiss said on CNBC he's bought it. Phillips 66, PSX, at $233.61 is advancing the $5 billion Western Gateway Pipeline with partners, a long-term cash flow project. Jabal JBL at $363.10, up 41.1% over 6 months, keeps earning praise as a value name as electronics manufacturing rides the AI buildout. And it doesn't hurt that technology earnings this season ran 646 on beats with raised guidance, confirmation for the whole infrastructure lean. A word of discipline before the smart money footnote. Momentum cuts both ways, and the fastest runners fall hardest when the tide turns. In a retirement portfolio, names like these are the growth sleeve, not the whole plan. We overlaid tonight's picks with the latest short interest data, and here's the healthy part. Across the board, the bears are behaving. No extreme buildups, no panicked covering. These moves are being driven by genuine buying, not short squeezes, the sturdiest kind of trend there is. So take stock of the picture. Nearly 100 names on buy signals, the same leaders persisting across every time frame and short standing aside. If that holds through next week's retail reports with Walmart headlining, this bull has room to run. This is education, not advice, but it's a good-looking picture. Top ETF picks. Now to exchange-traded funds, where our buy signal radar is unusually crowded today. More than 120 leveraged ETFs are on active buy signals, which itself tells you risk appetite is broad. The longest streaks run 4 consecutive days, and 3 of those stand out for a second reason. They also rank in our momentum screens. That's the Direction Palo Alto Bull Fund, ticker PALU, ProShares Ultra Nasdaq Cloud, ticker SKYU, and the Double Super Micro Fund, ticker SMCC. When the signal and the trend agree, conviction rises. But hear the caution clearly. Leveraged ETFs use derivatives to amplify returns and losses alike. They decay if you hold them, so they're short-term trading vehicles, not something to buy and hold in a retirement account or with money you're counting on. Keep positions small and have an exit plan. Start with what's hot this week. The Granite Shares Double Long Nebius Fund, ticker NBIL at $39.64, is the runaway leader, up 101.3% in 7 days, and also up 282.3% year-to-date, making it the rare fund near the top of both our weekly and yearly leaderboards. That confluence matters. The story is AI infrastructure. Nebius builds data centers, and money is chasing anything powering the compute buildout. Right behind it, the Super Micro Double Funds, SMCC at $41.45, up 52.6% this week and 87% on the month, and SKYU at $53.49, up 11.6% this week, 43.6% over the month. This is the AI trade in its purest form, and the technology earnings pulse we covered earlier backs it up. Every tech company that reported beat estimates and raised guidance. Now stretch the lens to the full year. The Double Long Dell Fund, DLLL at $29.30, is up 896.6% year-to-date and roughly 1150% over 6 months. Dell's AI server business is the engine. The Micron Double Fund, MUL at $22.62, is up 422.4% this year on the memory supply squeeze. And PALU at $62.97 has gained 270.6% year-to-date cybersecurity repricing for the AI era. Notice the pattern: servers, memory, software. One supply chain, one theme. The swing and recovery list tells a different story, beatdown names snapping back. The Super Micro Fund SMCX at $14.5 has surged 58% in a week. The Red Cat Drone Fund, RCAX at $5.59, is up 42.6%, though the sponsor just announced reverse stock splits across several of these leveraged products, housekeeping that can shake out smaller holders. The Intuitive Machines Fund, LUNL at $6.64, up 31.5% this week, carries the lunar economy bet. Most interesting is the Double Core Weave Fund, CRWG at $28.89, up 30.5%. CoreWeave just reported its computing capacity sold out, prices raised, and the stock has climbed since. Among the mainstream leverage plays, the AMD Double Fund, AMDL at $58.84, up 12.5% this week and 249% year-to-date. A 24/7 Wall Street piece framed it well this week. It doubles your AMD bet and doubles the concentration risk of a single chipmaker. Energy is the other theme. ProShares Ultra Crude Oil, UCO at $41.41, up 11.9% this week, as Reuters reports the U.S. threatened an indefinite naval blockade of Iran, and a drone attack halted loadings at a Russian Black Sea terminal. And for broad market exposure, the S&P 500 just logged its third consecutive weekly gain on bets the Fed holds steady. The triple S&P fund SPXL at $299.31 is up 11.6% over 2 weeks. Before we leave ETFs, a look at the short side. FINRA short volume data from Thursday shows a cluster of leveraged funds trading with nearly every share sold short, AMAN at 100% of daily volume, GCSH at 99.8%. Don't read that as doom. Most short volume is intraday market maker plumbing, and inverse bear funds naturally top this list. Heavy shorting of a bear fund is effectively a bullish bet on whatever sits underneath it. The real signal lives in the extremes, and in any overlap with the names we flagged today. On that overlap, hedger activity across our leveraged picks is broadly normal, no major shorting or short covering signal this week. The big money isn't fighting these trends, and that's about the quietest confirmation you can get. As always, this is education, not advice, because leverage cuts both ways. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. Quick primer before the numbers. Calls are bets that a stock goes up, puts are bets it goes down, or insurance against a drop. The put-call ratio compares the two. Above one means more downside bets than upside ones, which reads nervous. Today the aggregate ratio across the big index funds came in at 1.2, just barely more puts than calls. That's cautious, not fearful. The outlier is small caps. The Russell 2000 fund, IWM, traded 1.24 puts for every call. But look at pricing rather than flow. SPYs skew the gap between what out-of-the-money crash insurance costs and what out-of-the-money lottery tickets cost is just 2.6 points. Insurance barely costs more than the lottery ticket. So the flow says cautious, the pricing says calm, mixed signals, with the nervousness concentrated in small caps. Next, the market makers, the dealers who sell most of these options. They hedge with the underlying stock, and how they hedge shapes the whole tape. Gamma exposure, or GEX, tells you which mode they're in. Positive GEX means dealers are like shock absorbers. They buy dips and sell rallies, which dampens swings and pins prices. All three major indexes are in shock absorber mode today, and a volatility index at 14.25 agrees, but the cushions are uneven. SPY sits at $776.34, less than 2 points above its gamma flip at $774.40, the level where the shock absorbers switch off and dealers start amplifying moves instead. QQQ has more room. $731.7 against a flip at $712.79, roughly 2.5% of cushion. The knife's edge is IWM. Small caps are trading at $305.6, sitting exactly on their flip. And that's the same corner of the market where the put buying was heaviest. If the Russell slips below that line, its moves get supercharged. That's the one level to watch this week. Implied volatility is the market's forecast of how wild a stock will swing. Realized volatility is how wild it actually has been. The ratio between them maps where traders are bracing versus coasting. Most sectors sit near one, in line, no big dislocations. The richest are the bond proxies, utilities at 1.24 and real estate at 1.22. Options priced as if those funds will move about a quarter more than they actually have. The kind of premium you see when rate-sensitive sectors are girding for something. The cheapest, and honestly more interesting, are semiconductors and communications. SOXX has a ratio of 0.7. Options are pricing swings near 39%, while the sector has actually been moving at 55%. After a week where chip names sold off on strong earnings, that gap reads like complacency. 3 names on the flow scanner, all with confluence. Oracle, ticker ORCL, traded about 85,000 option contracts, roughly 85% as many as were already standing on the books, with a put-call ratio of 0.9. That's 11 calls for every put, and Oracle is also on today's swing list. Apple, ticker AAPL, printed a 0.24 on the day's flow, clearly bullish, and it was flagged by both our Senate and House trading screens this week. That's the strongest kind of confirmation we track. Qualcomm, QCOM, came in at 0.15, nearly 7 calls per put, and it also appeared on the Senate trading list. For anyone who owns shares and sells calls against them, a covered call, collecting a premium for agreeing to sell at a higher price. The scanner found real premiums today, mostly in chips and AI hardware. Applied Materials AMAT carries 88% implied volatility with an IV rank of 72, meaning volatility is rich versus its own recent history, and a call 15% out of the money pays roughly 57% annualized. SanDisk is even richer on rank 91 at about 56% annualized, and Dell around 51%. The honest caveat: these premiums are fat because the stocks move that much. A covered call caps your upside on exactly the rallies that would rescue a drawdown, so size accordingly. Now let's bring that backdrop down to our picks specifically, wherein today's stock list does options positioning also argue for higher prices. We screened 10 names from the show, 2 survived, and both made it on clear bullish positioning bias. The strict gamma squeeze checklist actually came up empty today, and that's worth understanding. The scorecard shows only the picks where options activity leans bullish. Neutral and bearish names were dropped upstream. Each row carries a squeeze phase. Pre-fire is a coiled spring, mid-fire means the amplifier is on, late means the move is mature, and long gamma means dealers are running a dampener. Both of today's names, Micron and Hewlett-Packard Enterprise, are tagged long gamma, a suppressive regime. Translation: no squeeze machinery underneath these stocks. The bullish case rests on positioning and flow, not on structural amplification. Here's the framework. A true gamma squeeze needs 4 things at once. The stock below its gamma flip so the amplifier is on, dealer gamma exposure actually negative, a call wall 3 to 15% overhead for runway, and a put wall in the same zone below for a floor. The second bucket is looser, names that fail the checklist but where dealer flow leans bullish anyway, an upside score well above the downside score. Today's rank 1 is Micron, ticker mu, at $971.66. An upside score of 32 against a downside of about 17, and it's our top pick of the day, with momentum and a buy signal stacked on top. Micron does not pass the strict checklist. It sits 7.8% above its flip at $896, deep in dampener territory, and the runway to its $1,000 call wall is just 2.9%, a hair under the 3% minimum. What did line up? A skew score of 13, flow at 9, earnings timing at 8. The contrast is HPE upside 32, downside under 2. That's about as lopsided as this screen gets. Micron first, at $971.66. Dampener mode, the flip sits at $896, well below. The next level to watch is the $1,000 call wall, about 3% up, where dealer hedging tends to slow a rally. The put wall at $800 is where dip buyers show up, and max pain, the strike where the most contracts expire worthless, often a magnet, sits at $910 below spot. Earnings land September 22, 39 days out, and they reset this entire map. HPE at $58.70 is the tighter box. Dampener mode again, with the call wall at $60, barely 2% overhead, the put wall at $45, and max pain at $50, well below a stock trading near the top of its range. Earnings arrive September 3, and that binary is the dominant force here. Micron under the hood, first number. Net gamma exposure of about plus $197 million. Dealers are long gamma, they buy dips and sell rips, which argues for range-bound behavior between that $800 floor and $1,000 ceiling. Second, implied volatility of 59.5% against realized volatility of 94.2%, a ratio of 0.63. The forecast is pricing less than 2/3 of the storm this stock has actually been delivering, so options are cheap relative to its real behavior, and the card flags premium as favorably priced. Third, the slow leak. Charm, how dealer hedging drifts as time passes toward expiration, runs at about negative $136 million a day. That's dealers as steady sellers into expiry, a daily headwind quietly leaning on the stock. And one unusual wrinkle, call skew at negative 4.8%, upside calls cost more than downside puts, the reverse of normal. Someone is paying up for the upside. HPE's card is simpler but blunter. Standing open interest, about 151,000 calls against about 50,000 puts, 3 bullish bets for every bearish one, the loudest ratio on today's tape. Same upside bid skew, negative 4.8%. Same negative charm, about $1.1 million of selling a day, trivial next to Micron, but the same direction. Volatility is fairly priced at 1.19 times realized, and with earnings 20 days out, the verdict is plain. This is an earnings binary now. The positioning is a runway into that event, not a guarantee through it. One honest frame before we move on. This whole segment is positioning context, not a trade idea. A picks list with a bullish options backdrop underneath is a higher quality setup than one without. That's the only claim. With that backdrop locked in, let's see what Congress was doing this week. Congressional Trading. Turning to Capitol Hill, where today's disclosure pile is led by Tennessee Congressman Chuck Fleshman. 11 ETF trades, all executed July 28th. He sold longer-dated treasuries through TLH, gold positions via GLDM and GDX, and an S&P 500 growth fund, while buying intermediate treasuries in SPTI and aerospace and defense exposure in XAR. Bill Keating of Massachusetts disclosed buys in HCA Healthcare and Capital One from late June, and Shri Thaindar of Michigan sold Apple, worth up to $250,000, in a trade dating back to January, alongside an older MicroStrategy sale. The stronger signal is clustering in the House. Three members, Gothamer, Rulli, and Mann, all bought Alphabet, ticker GOOGL. The same week Reuters reported Berkshire Hathaway lifted its Alphabet stake 83%, making it a top 3 holding. Khanna, Rulli, and Mann bought Meta, which sits roughly 27% below its high on AI spending concerns. Palantir, ServiceNow, Nvidia, and Microsoft drew buyers too, while Apple saw selling from 3 separate members, the week's largest sell cluster. Zoom out 30 days and the chambers disagree. The House booked 421 trades, 192 buys against 225 sells, a net selling tilt. The Senate, on 195 trades, leaned the other way, 101 buys to 93 sells. Where they align is Apple, the most sold name on both sides of the Capitol, with 8 Senate sales from just 2 members. Over the past month, senators have also been adding Realty Income, ticker O, the monthly dividend payer that just closed a $1 billion convertible notes offering, while House members pile into Meta. Insider activity. When several executives at the same company buy their own stock in the same week, that's the strongest bullish signal insider filings offer, and it's happening right now at Aptiv, ticker APTV. 2 insiders bought a combined $3.6 million this week, one of them boosting his stake by 54%, stepping in even as the company trimmed its outlook. 2 insiders also added to Berkshire Hathaway, ticker BRKB, though modestly, at about $250,000. The week's heavyweight buy came from Cascade Investment, the Gates family vehicle, which put another $186.47 million into Republic Services, ticker RSG. 14 insider purchases there over 2 weeks, against essentially no selling. Market-wide buying is running subdued, 67 buys versus 1382 sells, but remember, most insider selling is taxes and diversification, not a warning. The right panel ranks the truly enormous commitments, names outside the major indices. 10 different insiders poured $159 million into ticker BRVE, a coordinated vote of confidence in a small company. A single buyer, Albert Lord, committed $116 million to APCX on his own, and 6 insiders, including healthcare investors Frazier Life Sciences and Redmo, added $52.4 million to ATTO. Insiders sell for all sorts of reasons, but they buy for exactly one. They believe the shares are going higher. When 10 people who know a company best buy at once, or one investor writes a 9-figure personal check, that's about as strong a signal as this market gives. Federal budget. Through August 13, the scoreboard reads $137.6 billion in, $203.7 billion out, a month-to-date deficit of $66.1 billion, about $1.50 out for every dollar in. That's $83 billion better than last August, real improvement, but one good month can't close a gap this structural. Gross receipts were $141.3 billion, $3.7 billion went right back out the door as refunds, a round trip, not revenue. Where does it go? Social Security at $61 billion and Health and Human Services at $55 billion. The 2 entitlements alone are more than half the month's outlays. And the line that signals. Interest on the debt ran more than $100 billion last month, outpacing the entire defense budget. When interest outranks the military, the debt has become a spending program of its own. Thursday alone, nearly $4 billion in Medicaid grants flowed out to states, routine and enormous. Zoom out to the full fiscal year. $4.96 trillion collected, $6.44 trillion spent, a $1.49 trillion deficit through August 13. That's 4.2% better than last year's pace, but a rounding error improvement against a hole this size. The full year still paces to $2.16 trillion. The decade panel explains why. Spending jumped during COVID and never came back down. Outlays settled onto a permanently higher plateau while receipts only partially caught up. The purest expression of that is interest. $466 billion in 2017, $1.15 trillion in 2024, $1.27 trillion last year, now pacing $1.4 trillion. Tripled in 8 years, the compounding bill for deficits passed. That trajectory, not any single month, is what the bond market watches at the long end. All of it stacks onto a national debt of $39.9 trillion. The way to make that real is your share. About $119,000 per citizen, $266,000 per taxpayer. Call it $307,000 per household. That's a mortgage-sized obligation nobody signed for. And the pace matters as much as the level. It took until 2017 to reach $20 trillion. The most recent trillion, crossing $39 trillion this past March, took just 4.8 months. Each trillion now arrives faster than the last, which is why, at roughly $96,000 of new debt per second, $50 trillion projects to arrive around August 2029. Debt to GDP has pushed past the 100% warning line to roughly 123%. The debt is growing faster than the economy that has to service it, historically the territory of fiscal stress. So who holds it? Mostly us. Private domestic investors hold $27 trillion, roughly 68%. Foreign holders, $9.3 trillion, about 23%. Trust funds and the Fed make up the rest. The "our creditors live abroad" narrative overstates the case, but the lineup abroad is shifting. Japan still leads at $1.14 trillion, while China, steadily trimming, down from over $730 billion a year ago, has slipped to third at $659 billion, a quiet exit worth watching. Then there's the price of all this. The average rate on marketable debt has climbed from about 2.96% to 3.44%. Spread that across more than $31 trillion in securities, and you get the $1.4 trillion interest bill we just walked through. Rates did that, not new spending. Here's the trap. Of that marketable debt, $7.6 trillion, about 24%, reprices within 12 months. Treasury bills and floating rate notes rolling over constantly. Every 25 basis points rates stay higher adds roughly $19 billion a year in interest. A full point adds $76 billion straight to the deficit, which adds to the debt, which means more interest next year. The government has effectively financed itself with an adjustable rate mortgage, comfortable when rates were near zero, punishing now. The longer rates stay elevated, the more cheap legacy debt rolls into today's yields, a feedback loop feeding on itself. Week ahead. That brings us to what's on deck next week, and it's a loaded one. No magnificent 7 names this time around, but 3 giants report, and together they'll tell us a lot about the American consumer, the same consumer whose weak July retail sales unsettled the market just today. This is retail's turn in the earnings spotlight, with the Federal Reserve waiting in the wings. It starts Tuesday, August 18, with Home Depot, ticker HD. Home Depot is the classic homeowner bellwether. When families feel secure, they renovate. Wednesday, August 19, brings Target, ticker TGT, alongside Lowe's, ticker LO, TJX Companies, TJX, Estée Lauder, EL, and chipmaker Analog Devices, ADI. Then Thursday, August 20, the heavyweight. Walmart, ticker WMT, plus farm equipment maker Deere, DE, and Ross Stores, ROSD. Listen for Walmart's commentary in particular. Between groceries and general merchandise, it's about the best real-time read on household budgets anywhere. Now, the economic calendar. Monday quietly opens with the New York Fed's Empire State Manufacturing Survey and homebuilder sentiment, both expected to cool. Tuesday is the housing scorecard. July housing starts are forecast to slip to about 1.35 million from 1.427 million, with permits holding near 1.37 million, alongside industrial production and pending home sales. Wednesday is the main event, the FOMC minutes at 2 p.m. Eastern. After this week's soft spending numbers, traders have all but given up on another rate hike, and the minutes will show whether policymakers were leaning that way too. There's also a weekly mortgage rate reading, last at 6.77%, a reminder that home financing is still far from cheap. The week closes Thursday with jobless claims expected around 210,000, and the Philadelphia Fed survey, forecast to cool to about 25 from a very strong 41.4. On the IPO front, one name worth watching. Lintris, ticker Lynx, a defense technology company, lists on the New York Stock Exchange Wednesday. According to Reuters, it's targeting a valuation of up to about $2.5 billion, offering 24 million shares at $19 to $22 apiece. So mark the calendar, 3 retail titans, a full housing scorecard, and Fed minutes that could settle the rate debate. I'll be right here breaking it all down as the numbers land. That's your week ahead. As we near the end of the podcast, the key takeaways are these. The regime stays bullish, with unemployment holding at 4.1%, but July's retail sales drop, the first decline in 9 months, says the American consumer is blinking beneath this rally. The one thing to watch, with hedging near the lows, Wednesday's Fed minutes will test whether all that calm is truly justified. Every chart and number behind today's show lives at stockbeaver.com. Thanks for spending part of your day with Stock Beaver. I'll see you tomorrow.